GE Credit Slide Rattles Markets by Matt Wirz, November 15th, 2018, Wall Street Journal. Also known as Why It Doesn't Hurt to Have Some Extra Food in the Pantry and Some Cash in the Bank. GE was recently one of the safest bets in the bond market. Now it is hurtling towards junk. General Electric Company amassed $115 billion in debt on reputation as one of the U.S.'s safest borrowers. That's 115,000 times 1,000 times 1,000 for those that need some clarification. But revelations of losses and questions about its accounting have brought financial markets to a pivotal point. What? But revelations of losses and questions about its accounting have brought financial markets to a pivotal point. GE had a sterling AAA rating as recently as 2015. This month, investors have pummeled its bond prices into junk territory. Once a giant issuer of ultra-safe commercial paper, it now relies on $41 billion in revolving credit lines from more than 30 banks, the corporate finance equivalent of a wallet stuffed with credit cards. For people that work at GE, that means your payroll, either on a weekly, bi-weekly, monthly basis, depending, is getting paid by bank loans. Love you, Rob. GE stock had lost about half its value in 2018, and ratings firms cut its credit rating in recent years to BBB+, 3 notches above junk. GE's various bonds have pummeled about 5 to 18% since last October, according to market access, showing that some investors expect further downgrades. Trade and derivatives protecting against a GE default also surged on buying from banks and bond funds. So banks and bond funds, who are really limited on what they can buy, are starting to bet against them. Newly installed Chief Executive Larry Culp is selling parts of the company to raise cash and slash debt, including Tuesday's announcement that GE would sell a $3.7 billion stake in Baker Hughes, a GE company which sent GE shares up 7.8%. Page turn. A slide below investment grade by GE, a name many people associate with safe and boring investing, could reshape the junk bond market. GE has so much debt that it would become about 1/10 of the $1.2 trillion market, according to data from Fitch Ratings. The shift would also force fund managers to question how well they understand the risk in their investments and potentially hurt prices for other high-yield debt. It's a relatively systemic company, says David Manere, founder of hedge fund Mill Hill Capital, which has been betting against GE by using credit default swaps or CDs since July. Do you guys remember hearing about credit default swaps after 2008? I do. I remember that. It would be extremely concerning to have that much paper moving from investment grade to high yield, unquote. Bond investors said they are selling in part because GE's complex financial reporting makes it hard to analyze if more unexpected losses will be revealed, triggering another sudden downgrade. Let me repeat that. Bond investors said that they are selling in part because GE's complex financial reporting makes it hard to analyze if more unexpected losses will be revealed, triggering another sudden downgrade. The company is considering breaking out financial performances of individual subsidiaries to provide greater transparency to investors. A person familiar with the matter said, GE management aims to recapture a single A credit rating through divestitures and by refocusing on its power and aviation manufacturing businesses. Divestitures, that's selling off, selling away, splitting up. GE became a bond market titan in the late 1990s when its AAA credit rating helped it borrow cheaply to fund manufacturing and to raise money for its financing arm GE Capital to lend. So they borrow money and raise money for their financial arm to lend. The company has cut debt from a peak of $336 billion in 2009, but lost its AAA rating in 2015. Its bonds remain widely held by insurers, pensions, and mutual funds, many of which have rating requirements that force them to sell bonds rated below investment grade. A short-term bond fund operated by Vanguard Corp owned $1.4 billion in GE bonds as of October, representing 2.4% of its assets, according to data from Morningstar Inc. The fund can invest no more than 5% in junk debt, a spokesman said. MetLife Inc. owned about $300 million in June, but has since reduced its holdings, which now make up a fraction of 1% of its investments, a company spokesman said. Bond prices began their recent fall in late October when the company disclosed $22 billion in unexpected charges tied to its power unit after reporting a $6 billion shortfall in insurance reserves in the first quarter. GE's bonds have been the most actively traded in the U.S. corporate debt market over the past 2 weeks, with more than $10 billion changing hands, according to Market Access. Some bondholders are purchasing credit default swaps, which pay out if GE defaults to protect themselves, while hedge funds are buying the swaps at a bet that they will rise in value as the company's fortune worsens. So, you got people betting against, and then you have people buying that bet because they think it's going to be even worse. Prices of GE CDs, credit default swaps, roughly doubled in November, and the dollar amount of swaps outstanding quadrupled to $836 million, the highest amount of any corporate borrower in the world, according to IHS Markit and DTCC data. Wall Street banks with lending commitments to GE also are buying CDS, credit default swaps, to protect loans to the company, according to people familiar with the trades. Banks account for about 10% of the recent GE CDS transactions, one of the people said. The recent downgrades made borrowing through commercial paper more difficult for GE, and the company is increasingly drawing on $41 billion of credit lines provided by more than 30 banks to fund itself, according to its quarterly earnings report. GE's lenders include Citigroup Inc., Goldman Sachs Group Inc., and Morgan Stanley, according to its 2017 annual report. The firm has borrowed $2 billion of the loans so far, a company spokeswoman said. The more GE borrows from the banks, the more CDS they will buy, pushing the cost of the swaps higher, increasing the perceived risk of default, Mr. Menere said. Current CDS prices implement a default risk over the next 5 years of about 16%, almost twice the approximate 9% risk implied at the end of October. The sharp moves in GE debt and derivative prices reflect concerns that further losses or cash shortages may be revealed, investors said. So, a couple takeaways. You probably own GE bonds. Ton of insurance companies and and investment firms, including for the life of me, what have you, including all your retirement accounts have some GE in them. So don't be surprised when the price drops. Don't watch the news. I mean, you're going to have those people with the talking heads on TV yelling and backing and forth, and that type of stuff just drives the anxiety. Sit back, have a cup of tea, have a beer. Your investments, I'm pretty sure, are going to drop for a bit, and then they'll come back. Don't be surprised. As my buddy Randall says, it'll be fine. Other than that, have a good day.